following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
Hello and welcome to the Advisor's Option, the program designed for busy financial advisors and asset managers and financial planners who are interested in adding options into your portfolio mix. We're going to give you some ideas on how to do it and some practical tips on how to implement them as well to make it easier to use these products for you and for your clients. My name is Mark Longo from theoptionsinsider.com, as well as from the Options Insider Radio Network. We've got another great episode in store for you. The boys from OIC couldn't make it today, but we are joined by two of our regular stalwart contributors here on the Advisor's Option, starting off beaming in all the way from disaster-ridden Colorado. He is Randy Swan, the co-founder of Swan Wealth Investments. Randy, welcome back to the show. Glad you can make it even in the midst of all that chaos out there in Colorado these days.
Thanks, Mark. It's been a very interesting summer with all the wildfires this summer, and now we're getting floods. But the rains are definitely needed at this point in the Rockies.
You think maybe the floods could have come a little earlier to put out the wildfires, and then it would have been all set, but they didn't. They didn't work out that way.
That would be asking for too much.
And a little bit closer to home, we are also joined by good old Mike Cavanaugh from RCM Asset Management. Mr. Mike, welcome to the show, sir.
It is great to be back. Thank you very much, Mark. Randy, I'm glad that Durango is not in the midst of the fires and the floods.
Thank you.
Yeah, you guys have a nice little secluded, out-of-the-way spot out there, so you've missed all the host of plagues so far.
That's exactly right. We did. The last time we had a really big forest fire that really affected our community, I think, was probably in 2001, but it's definitely been interesting.
And speaking of interesting, that's the perfect cue to segue right into our first segment, our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, welcome to Options 101. As the name suggests, this is, of course, the portion of the program where we lay out some interesting basic options concepts that could be useful for you, the active financial advisor or asset manager. And we were talking before the show about what strategies and what concepts might be interesting for you on this episode. And then we all came to a sudden realization that, wait a minute, we haven't discussed this topic, this strategy that is indeed very useful for a lot of long-only equity managers and financial advisors. It's called the stock repair strategy. And as you might imagine, given the name, it's a useful scenario, useful strategy to have in these scenarios where you might have a little bit of a downturn in the market. We've been rallying for quite a bit now in the marketplace. Now we're starting to see a little bit of vacillation, a few days of down days, a few days of up days. So your clients might start to have some drawdowns in some of their holdings. This is an ideal scenario for the stock repair strategy. It's essentially, the old narrative for a lot of stock traders is you bought XYZ stock at 50, well, it drops to 40. Well, if you liked it at 50, you have to love it at 40. So it's time to come in and double down and buy some more. And then, of course, you're lowering your average cost, and then you're lowering your break-even point as well. And there's a certain logic, a certain understanding behind that of why you might go that route. And it's been the way it's been done for a very long time on the equity side of the fence. But there's a number of downsides to that as well. The first off is that it requires a fresh infusion of capital to come in and buy more stock. And also it's going to tie up that capital for a long period of time. You could have put that to work doing other trades or other things, but instead you're tying it up in this already losing position, potentially throwing good money after bad. So there's a lot of reasons why that isn't ideal. Of course, the other alternative in the equity realm is just to hold it. And that's the old joke we have in the trading realm where this was a short-term trade. Oh, now it's a long-term investment because the stock is down 10 or 20%. How many times have we all heard that? And a few of us have even said it on occasion that your outlook has changed because you want to make that money back. You want to get back to break even on behalf of your clients. So those are difficult times for the advisor. The client usually is upset. There's some conversations about why that draw occurred. And the usual equity strategies may not be sufficient to get you back where you need to be and to get that break-even point in a much speedier time frame. And that's where options can come in, and they can be very handy. It's the old stock repair strategy. And so, Randy, I know you guys probably implement this a lot, or at least you probably used to, and a lot of advisors still find this approach very useful. So why don't you outline the basic stock repair strategy for our listeners and some use cases where they might find it beneficial to them?
Sure. Let's say that someone likes ABC stock and they purchase ABC stock at $50 a share, and the market goes through a correction, or the stock goes through a correction, and it drops down to 40, as you mentioned earlier in your example. What do you do at that point? You obviously have a choice to liquidate the holding and take the loss, take the 20% loss, or you can also potentially start engaging in some type of covered call writing program and or put selling program to kind of average down your costs in the stock. So what in this example, I think if you sold it originally for 50, the question is, could you sell some options at 50 that would allow the stock to rebound to 50 and get your money back, or actually make a profit at that point with the option income? At that point in time, that stock may have dropped so much that you may not get very much premium on that, but that's one of the ways you can do. So you're actually trying to force the situation in terms of trying to get your money back sooner by introducing the concept of selling premium into that. Another way to handle that repair strategy would be to actually double down in terms of buying more stock and or selling more puts to basically get some more premium in there. And so what you're trying to do is just trying to shorten the time length that it may take to get your money back. Obviously, over time, if you're selling enough premium, then that would close the gap, assuming the market doesn't go up. Some of the pitfalls are if the market the stock continues to drop even further, then you're just digging yourself in a deeper and deeper hole. So that's obviously one of the negatives of doing that. And of course, I know we've all probably done this in the past where the stock takes a dive. You start selling some calls. Maybe you can't sell the 50 calls. Maybe you sell something like the 45 calls or the 40. And of course, 2 months later, it's rebounded. It's back up to 50, and you've essence locked in maybe some losses on the stock at that point. So that's just a general brief overview.
And now, Mr. Kavanaugh, I know you guys and Mr. Tucson and all the rest over there at RCM, you guys like to employ this strategy on a regular basis. Not to say that you have drawdowns on a regular basis, but it does happen to the best of us. I know when you do, you like to employ this strategy. So why don't you walk us through some scenarios where you might want to implement a stock repair strategy?
Yeah, Randy did a good job of outlining, the world famous XYZ stock. If it's trading at 50, and you're a long-term holder of the stock, you know how Randy outlined it. It reduces your cost basis by selling the calls. I always bring in 2008 and the dot-com boom in 2000 when people were doubling down. If you bought Oracle at 120 and it was trading at 60, well, if it was a good buy at 120, it's a great buy at 60. You got to go 4-to-1 when it's trading at 30. It's at 15. Well, if it was great at 30, you buy. And people have gotten burnt by abusing what some people call dollar cost averaging. So the first part of a repair strategy is to define your time sentiment. I mean, if you're a short-term trader, you're probably not going to hold a stock from 120 down to 60 in the first place. If you're trading something long-term, and you've got a really good feeling about a stock, a ratio spread is what we've had the most success with in the past as far as a stock repair or, profit enhancement strategy. And really the easy way to describe that is you buy the stock at 50. It goes down to 40. You're still bullish. You don't want to add any additional risk to the position, but you want to enhance your profit if the stock were to go back to 50. So you select your time frame, and you basically buy a 40 call, and you sell 250 calls. Ideally, you'd be able to sell the 250 calls to purchase the 40 call and do it either for a break even or a net credit. And what this does is it lowers your break even to 45 without adding any additional risk to the downside. If the stock were to go down to 30, you're basically financing the call that you purchased to double up on this stock by selling the 250 calls. So your break even's 45 now. You've got double the profit back up to 50, and if the stock goes above 50, you have to make a decision on whether you're going to buy back one of the calls or just let it get called away. So that's been a stock repair strategy that we've had the most success with. Clients like it because it gives them the ability to double their exposure without adding any downside risk. If the stock went from 50 to 40 and you bought another 100 shares of XYZ and the stock goes to 30, you've actually doubled your risk while you doubled your upside. The trade-off in this strategy is obviously you're capping your upside at 50, so if the stock runs away, you've only doubled your upside from 45 to 50. And I've got full PowerPoint presentations on repair strategies. If anybody is interested, I can zip it off to them.
I guess another repair strategy that I would just point out is if you're not confident the stock will ever go back, there's a certain point in time if you get enough premium along the way and you don't add to your position in terms of buying a call or adding stock, where over time you could earn enough premium to make up the loss. But that's probably a very long-term play to get that back.
Yeah, that, as you guys have outlined, there are numerous different strategies that fall under the general umbrella of the stock repair strategy. You can do kind of as Randy outlined and chip away at it a little bit over time by writing options and collecting premium and hoping that premium is going to offset your losses in the underlying. As you might imagine, that could take some time depending on how in the money and how meaty those options are that you're writing and what the underlying does in the meantime. If the underlying is sitting still and you're able to write premium effectively against it, that may not be a bad alternative. But the common use case, the common scenario a lot of people like to describe as a stock repair strategy is kind of what Mr. Kavanaugh outlined there, which is you have the underlying in XYZ, stock drops from 50 to 40, now you're down 10 points or maybe $1,000 on 100 lot of stock, and instead of just doubling down on the stock and lowering your break even, you instead buy a call and then write 2 out of the money calls on a ratio, a typical nice little ratio spread, and now you have a nice position. And you could write the calls, and that's kind of another way how the stock repair strategy can vary depending on your outlook. You can do what Uncle Mike suggested, which is you write the calls all the way at the 50 strike, which is back where you bought the stock, and so if it rallies all the way back up, you're actually profitable. If you're not convinced that perhaps the stock's going to get back there and anytime soon, you maybe write them at a lower level, so that maybe 45 level, so the stock rallies 5 points instead of 10, and now you've broken even on everything and you can close out the position. So there are a lot of great ways you can construct the stock repair depending on your outlook and depending on what you're comfortable with to really make that break even come a little bit faster for your clients and end those calls all the time of, why am I going to break even on this? Why are you still in this position? Now, we mentioned before the additional cost it requires if you're going to double down on the stock. One of the nice things about the stock repair strategy, because we're talking about a ratio spread. Remember, a ratio spread is really buying one nearer the at the money or more in the money type call, lower on the call option chain, and then selling two of and farther out of the money call on the option chain. So instead of the typical vertical buy one, sell one, so you have a net even spread, you're buying one now and selling two. And you might say, well, wait a minute, there's some naked risk there, but remember, you also have the stock in your account as well. So that counts as essentially another call in your back pocket. So because you're doing this call spread on a ratio, you can usually buy the additional call, get the additional leverage, get the additional bang in your portfolio for very limited, if not free, if not for even, depending on how you do the ratio. I mean, obviously it depends on the underlying and how you leg into the spread, but essentially the ratio spread should cost a nominal amount, if not be free, depending on how you do it, in which case you're talking about lowering your break even and increasing your probability of breaking even with zero net additional outlay for the account. And that's an attractive prospect compared to going out and doubling down and buying a lot more stock or some of the other strategies you might think of in this scenario. So the stock repair strategy, again, if you have some drawdowns, you have some near-term pullbacks in some of your underlyings, and you have more of a longer-term outlook on them, you think it's going to retrace at least partially, and you want to make some or not, if not all of that money back, the stock repair strategy is a great strategy for you. Of course, like I said, there's a lot of different ways you can do it. You can change the ratio. You can make it net short. You can do a lot of other things. There are a lot of different ways to try to make up that shortfall using options. But again, the basic stock repair strategy, long stock and then long a ratio call spread. And that usually will do the trick. Mr. Kavanaugh, Mr. Swan, anything else you'd like to add on the old stock repair strategy?
Well, I was going to say one thing in terms of this wasn't originally presented in terms of you already owning the stock, but in a lot of situations this would have been already combined with some type of covered call in the beginning when it started dropping from 50, and so hopefully you didn't wait till 40 to start doing anything. In our example, or the way I would be doing that is that you'd be wanting to write calls and repairing it as it's going down, not waiting for the proverbial 20% drop. So if you're a little more nimble and taking advantage of the originals, as it's starting to sell off, I think you can make that. You can fix that problem a lot quicker if you're more active.
That's a good point. If you're a little bit more of a hands-on advisor or asset manager and you start noticing a drop down in the stock, don't wait. There's a lot you could do. You can adjust the position. And like Randy said, a lot of you may get into this scenario because you've already established a covered call position. So then you already have that short call. It's a simple matter to roll that call down farther or even write additional calls on the way down to collect more premium and to offset some, if not all, of that downturn in the underlying. So if you're a little bit more nimble, a little bit more option savvy, you can do exactly what Randy said. And then in that case, you don't have as long of a road to hoe to make it back. You may have reduced substantially your drawdown, and then you have a lot more options for what you can do to really make that back. You can go back to what we discussed before of perhaps some type of aggressive premium selling type strategy, calls, maybe additional puts if you want to perhaps double down the stock if it continues to drop. A lot of different ways you can pursue that, which is why we probably could do several episodes just on stock repair and using premium strategies to repair drawdowns in an equity portfolio. If we wanted to give you a basic overview of what we're talking about today, that's a great tool every financial advisor should have in their trading arsenal, the stock repair strategy. If you have more questions, like you said, you can contact Mike Kavanaugh over there at RCM Asset Management. You can go through all of his white papers. Randy, I'm sure, and his team over there at swanwealthadvisors.com would be happy to help you. Of course, we have a lot of information available on the optionsinsider.com as well. Just search for stock repair. There's a lot there. There will be a lot more coming soon, so stay tuned for that as well. But now we have to keep on rolling right on into our next segment, The Buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, welcome to The Buzz. This is the portion of the program where we break down some interesting trends and developments we've seen in the options and alternative space here. that you as the busy financial advisor may not have been aware of. And before we started the show, I talked to our friends over at OIC and they couldn't make it. I said, there's any interesting developments you want to hit on the program? And they mentioned this survey, which I think will be interesting to a lot of the listeners of this show as well. This is a survey that comes out of the firm Natixis, and they do a lot of surveys on advisors and alternative investments. And I know a lot of you may think, well, options, you may take issue with that classification of options as an alternative investment, but for whatever reason, they are lumped under that general rubric of alternatives. So when they talk about alternatives, that usually applies to options as well. And they had some interesting findings in a very recent survey that they did. They surveyed a lot of their different investors and typical clients, and they found that 72% of investors would consider alternative investments if their advisor recommended them. That was up from 35% last year, and it's an enormous leap from just 19% in 2011. I'm not sure what's more shocking, the 72% here in 2013 or the 19% in 2011. That's a very, very low number. This was a global asset management survey. They said 43% of people right now are already willing to invest in alternatives, and if they've got a little bit of extra push from their advisor, that number goes up to 72%. They also said, what are some of the stumbling blocks? What would keep you maybe from doing this? They said 85% of investors said they would invest in these alternatives if they understood them better. So that gets back to what we're talking about on a show like this, providing some of these basic concepts for you, the advisor, so you in turn can go out and explain them to your clients so they're more comfortable when you do something like a stock repair strategy in their portfolio. It just makes more sense. If you're starting from zero and they really don't understand what you're doing, that's a much longer road to hoe. But if you can provide them with some education and some information along the way, make it a dialogue between you and your client, then the results are much stronger. Let's see, this survey was a survey of 750 U.S. investors. This came from a global survey of nearly 6,000 investors from 14 countries. The investors had at least $200,000 in assets. So I think this is an interesting thing. We talk about alternatives, obviously, a lot here on the show, mostly options. But it's nice to see that mindset is shifting. Mike, I mean, you guys obviously deal with a lot of these clients like this on a regular basis. Would you say that your anecdotal...
Most of the calls we get would definitely support it. I would say in general, probably more so now than in the past 5 years.
That certainly seems to be the case. Only 19% of people in 2011, that's just 2 years ago, were willing to even entertain the notion of what we were talking about. Good thing we didn't launch the advisor's option then.
Yeah. Well, I mean, I think a lot of it has to do, and this is just me speculating, but I think a lot of it, the interest is coming from the yield market environment. Smart money is not going into 30-year bonds anymore, and they're looking for bond-like risk with equity-like returns. That really the only way to enhance a portfolio without getting into completely alternative strategies, which was talking to our friends over at the trading block the other day, and they made a good point that options aren't alternative investment strategies. They're a derivative product that are meant to hedge and potentially add income to a portfolio. It's not an exotic. It's a vanilla. It's not alternative. It's it's Main Street. So the fact that I think more people are trying to not let a 2008 disrupt their portfolio like it did in 2008, and the yield environment being as low as it is, I think that's why you're seeing an interest rise in options. And guys like Randy, myself, other advisors that are very accustomed to using options are getting phone calls saying, what do I need to know? How do I do this? As an advisor, I'm getting demand from my clients on the proper use of options. What do I need to know?
And Randy, obviously you're out there dealing with a lot of, not the individual investors per se, but a lot of the managers who deal with the individual investors on a larger scale. Would you say that what you've been hearing and seeing backs this up as well?
Oh, absolutely. I think it's, as Mike already said, it's the yield on bonds right now, the perceived risk on stocks. I kind of use the baseball analogy of small ball. Investors see that the options out there, the investment alternatives out there are not they want something different, and so that's why they're willing to look at other places. They, I always look at the option strategies that we employ at Swan is exactly that. It's small ball. It's trying to manufacture income in an environment that's not necessarily conducive to, investing in a bond yielding, 6 or 7% or something like that. So I think that's why the shift has occurred, because people just realize that they can't get what they want using the traditional investment paths.
So that's the approach that you're finding the most productive for you right now, is just discussing options on a pure yield and income generation basis. That seems to be the most attractive.
Yeah, we normally use our strategy, and we try to explain our strategy as more of a core replacement. But when you get into certain people that say, hey, I've traditionally allocated, let's say 30 or 40% of the portfolio to fixed income bonds, and now those bonds don't look like, it's a very attractive investment going forward. And then you take what we've done historically in terms of our income generating strategies and say, hey, that could be used as a bond replacement. That is the characteristics that we want in an investment, is, something that has traditional, more bond type risk, although I would argue at this point there's probably a lot more risk in bonds than historically true. That's exactly why our strategy is getting a lot of interest.
And Mike, I agree that, this lumping options in under alternatives, it usually always rubs me the wrong way, because it's when you start talking about alternatives, you can get in some really funky lands, and you're right. Options are options, usually writing a covered call on a stock. That's pretty straightforward. But another interesting finding I saw coming out of this study of alternative investments, they found that almost all of the investors they talked to, at least the 765 in the U.S. portion anyway here of the 5,000 or so internationally, of those investors, 86% said they pay attention to the overall risk, which is interesting. But I think even more interesting is this next number. And they said 82% try to actually measure their investment's risk. Now, when people start talking about risk, in particular attempting to quantify it in any way, shape, or form, just beyond the simple Sharpe ratio, that discussion usually eventually comes back to options, because they discover that options are one of the few, if not only, ways to really to provide that inverse correlation to reduce the overall volatility, to reduce the overall risk, the standard deviation of their portfolio. So if they're indeed as sophisticated as they claim here, and if 82% of these investors are indeed trying to quantify their risk, then I would be surprised if they didn't have at least some options component in their portfolio. And that sounds like that's a client. If you're an advisor, if you have that client out there who's trying to quantify their risk, then that's an ideal client to try to approach with options, because they will really, that discussion we've had many times on the show of reducing risk, of reducing tail risk, of reducing volatility, of providing inverse correlation, of reducing standard deviation, all these things we talked about on the show many times that options can provide. That discussion, that argument will resonate a great deal with that particular type of client. So this survey all around I thought was very interesting, and interesting for a lot of our listeners as well, who may still be on the fence. I know you guys, Randy, and you guys, Mike, you guys have done it successfully, but a lot of our listeners may still be on the fence about approaching their clients about options. So if you are, maybe this survey will provide you with a little bit more ammunition in that discussion. If you want to find the full results, just search for Natixis, Natixis, and their alternative investment study, and you should be able to find it for yourself.
Well, I would like to throw one last comment out. I think that the 86% that you mentioned is that people are very fearful of what happened in 2007, 2008, or early 9 happening again, and they do not, especially as you get the kind of aging of the population, people's portfolios can't afford another scenario like that. So people are a lot more in tune, and I guess at some level, notwithstanding the market's a lot higher than it was 5 years ago, I think at the end of the day, people just don't trust this rally, I guess is the best way to say it.
Never trust a rally. That's always words to live by. But you're right, Randy. I kind of agree. I think people are a little bit cautious. They should be, given all the things we've seen. And that's why I'm still trying to reconcile in my head these two numbers. The 82% of people who are quantifying their risk in their portfolio, yet this same survey said 2 years ago that only, 19% of their respondents were actually interested in alternatives. If they were indeed quantifying their risk, and if indeed options are included in alternatives, which I'm sure they are, then you think they would have a much higher number. I mean, what does it take post 2008, 2009? What does it take to make you wake up to the fact that you need some sort of hedging or diversification strategy, probably using options to really protect yourself? It always amazes me that even in the wake of that giant meltdown, which is coming up on 5 years for us now, there still is some pushback to something as simple as buying a put or a collar. It's amazing.
It is amazing. The one thing that, the numbers, obviously, they kind of jumped, the 19% jump to 86% in 2 years. But I guess I would want to know not the quantification as much as the qualification of what do they mean by they're measuring their risk. I think that there should be orange jumpsuits for the quants that came up with the 3-letter acronym for VAR, value at risk. If people are measuring portfolios and the qualifications are based on values at risk, I would highly question that 86% of people. Now, if people are dealing with more absolutes and are incorporating option strategies, put anchors, selling calls to finance the married put anchors, that gives you more of a absolute versus a VAR risk measurement. Value at risk just gives you an excuse to use more leverage, and it even skews your value at risk even more. So if the 86% of people are now looking and dealing with their risk management and risk assessment from an absolute measure, then I think that those 86% of people will find that if the market goes down, they won't be as displeased with getting their statements as they were in 2008. But if they're measuring the value at risk in their portfolio using the VAR methodologies, I think there might be some people that are questioning their risk assessment and risk management applications.
Yeah, I agree. I'm always kind of dubious when I hear those kind of metrics thrown out there as well. I want to hear exactly what they're using. In my head, I just think they're using Sharpe ratio, something as basic as that. Hopefully it's a little more advanced, and hopefully it's not VAR. But I guess we'll see when we start digging in a little bit more into that survey. And I think, like I said, a lot of our listeners should do exactly that and use some of these findings to inform their own practices and how they talk to their clients about different types of asset classes, including using options. All right, and speaking of talking to the advisors, it's time to do just that, because we're going to roll right on into our listener mail segment.
Listener mail. Listeners write in. Mailbox.
All right, and welcome to the old mailbag. This is my favorite portion of the show because it gives us a chance to respond directly to you guys out there in the listening audience, and you guys always have a lot of great questions and comments. If you'd like to join your fellow listeners here on the old mailbag, a lot of great ways for you to do it. You can, of course, surf on over to theoptionsinsider.com, post a comment on the show notes for this very episode or other episodes of this show, and we'll route it to this program. You, of course, can find us on Twitter, twitter.com/options, facebook.com/theoptionsinsider, or contact us the old-fashioned way, questions@theoptionsinsider.com. Just put question for the advisor's option in the subject line so we know which show you're referring to. And kicking off the old mailbag today, we have a question from Gabe Shahir, and he writes, "The majority of my clients have large concentrations of assets in 401k plans. These plans are usually very limited from an asset allocation perspective," and he puts in parentheses, "very broad mutual funds, large cap, small cap, etc. With such a prolonged rally in the stock market, many of my clients are looking for ways to protect the gains in their 401ks. Short of divesting the positions and going into cash, a typical 401k doesn't offer much in the way of hedging opportunities. How can I use options to protect these clients?" It's a great question, Gabe. We get variations on this question quite a bit on this program and other programs on our network. It's a very common concern. You have a lot of your assets locked away in these very restrictive type retirement accounts, and it's not like an IRA. We can just come in and write a lot of calls on it. Usually you have a handful of investments that are chosen by your employer or your employer's plan, and you're limited to that, and what you can do outside of that is very difficult. So clearly, if you want some sort of hedging, some sort of tail risk protection, it becomes a more difficult proposition. But there are ways you can do this. And Randy, I know you guys over there at Swan have a lot of history of overlaying different types of portfolios. So this question seems like it's right up your alley. What would you tell to our friend here, Mr. Shahir?
Well, I think the first thing is to discuss what options you really do have in a 401k. Like you said, I don't think there's any 401k plans that allows you to use options directly. That means that your only route would be to use a mutual fund that uses options like ours. Whether that's available on your particular platform is another issue, but it all comes back from demand from the individual clients or the participants in 401k plans to get the products they ultimately want. One of the basic components of our strategy is to take advantage of a situation that we're in right now after a 5-year bull market. And what our strategy typically does is actually re-hedges the underlying portfolio on an annual basis. To do that exact thing is to lock in the gains from the prior years. So we've actually been moving up our hedge protection all the way from 650 on the S&P in March of 2009 to all the way up to 1700 right now. So it may not be the answer you want. I think that as time goes on, as we talked about in the earlier study that we just discussed, there's going to be more options that you're going to be able to do, and it's just a matter of getting the individual investors to clamor for products like ours on their platform over time.
That's a good point. I mean, there aren't really right now many funds at all out there that are using options, at least on a very advertised basis. There are a lot of mutual funds out there that might be writing some calls every now and then to generate some additional income. That's usually about it, and it's not highly advertised or a big part of their strategy. They usually try to cover that part up. But none of them that I can think of, at least very few, are actually out there doing a very actively managed options overlay type strategy along with the underlying. That's what you guys over there at Swan, that's exactly what you guys are doing. So that may be one alternative, is to talk to your employer and say, hey, can we get this Swan mutual fund, have access to this in our 401k, because that would take a lot of the work out of it for you. Randy, if they want to get that mutual fund, what's the ticker? How do they go about it?
The iShare is SDRIX, Swan Defined Risk, and then institutional share. We are on a lot of platforms. The 401k market is something that we're actively working on right now. As you can expect, it's a very long process to get that done, but it kind of feeds into the dialogue I think that we've had over the last several years. Is the industry is in fact changing, and over time it will come. It just takes a lot longer than you thought. We've had to fight these battles with different custodians about using an active option program for our SMA program and stuff like that. So it's just one of those things that, unfortunately for you, it takes time. It's kind of like the analogy of, my neighbor across down the street has cable, and I can't wait till I get cable. I have to wait another year or two. So these things go from the SMA level to the mutual fund level to eventually a 401k market. But I can tell you this right now, we have talked to a lot of firms, and we are getting a lot of interest in having a product like this on 401k programs. So I know it will eventually happen.
It is still pretty disgusting in this day and age, the limited number of choices you really get with these types of accounts. Now, Mike, I'm sure you get this question probably every week or two, people coming to you with this type of thing. And while they're waiting for these firms to approve something like Randy's mutual fund, what do you typically counsel the clients coming to you guys? You set up some sort of shadow account, and then do you try to figure their approximate relationship to the S&P and hedge that way? What's the approach you guys take?
Yeah, I mean, there's no question that the solution Randy outlined there is the easiest. Outside of having a mutual fund like Randy's, and what they've got at Swan on the record keepers platform that you can invest the money to, if you're concerned that the market's at a peak and you want to shift into a more risk managed feature on your record keepers platform, the easiest way is how Randy outlined it. There are other options. You have to check your summary plan description to see if you have in-service withdrawal capabilities. Generally, you have to be 59 and a half years old to have in-service withdrawals, and the SPD outlines the rules of what you're allowed to actually withdraw. Outside of that, the only other two options that I can think of is, like you mentioned, Mark, like some sort of phantom account that you work with an advisor to fund an account outside of the qualified aspect of your 401k and use that extra money to hedge your 401k, which can sometimes be very clunky. It's not, being reported through the same system in most cases. The only other trend that I see is, and I don't advise people to do this on their own, is a self-directed 401k option. And a lot of record keepers are moving in that direction, where you can use an online broker-dealer like a TD Ameritrade or a Charles Schwab, and you can actually choose an option to manage the funds within your 401k on your own. But that necessarily isn't the best thing. Employers hate when 401k advisors actually mention that kind of stuff, because they find their employees are trading away at their desk instead of pushing paper or doing their actual jobs. So there are other options, but the one that Randy highlighted is probably the most feasible. And it's just, it comes from the demand of the employee to get those types of products on the record keeper.
Yeah, certainly something that is included in the 401k account itself is the ideal scenario. These secondary shadow type accounts, and setting those up, you're right, they're very clunky. They're not tax deferred. All the other things, the ratios are never exact, so you can never exactly hedge. You're funding an account that usually, if the other account is doing well, is losing all the time. So it's a weird thing to have to manage and adjust on a regular basis. But it's one of the only ways to do that right now, short of having a product in the 401k that will do that for you. Which it just seems antiquated that you have these options, pun intended, in something like an IRA, where you can write calls and generate income and have that income be tax deferred, and all these relatively sophisticated things you can do. And you have these 401ks that are still stuck in the 50s, it seems like, from what they allow you from an asset allocation perspective. It really is just an unfortunate scenario. And the sooner we can get some better product selection, better product choices in these 401ks, and more investment strategy options, the better I think it will be for everyone. All right, so moving on here to our next question. This comes from Mr. Alex, I guess that's Tophus, and he writes, this is kind of related to what we were just talking about. He writes, I often utilize leverage short S&P ETFs to hedge my equity accounts. Isn't this a preferable option to buying puts, pun intended, he's stealing my joke, for most advisors, since they don't need to master a new asset class to protect their clients? This is another question we receive on a regular basis here on the network, and I was waiting for it to come into the advisor's option. I knew it would sooner or later. These products are very popular. A lot of people like them. I often refer to them as the shorthand of just the poor man's option, and the reason I do that is because they attempt to offer some of the functionality, some of the leverage, some of the value of options, but without requiring you to have to listen to a show like this and to have to learn about a new asset class and how they work and how to properly implement them into your portfolio. So on the surface, they could be an attractive option. They could really, it seems like a shortcut to being able to get all of the benefits of options. But the truth is, I call them the poor man's option for a reason, is they usually don't perform as well, if even anywhere close to as well, as a hedge you've constructed yourself, whether it's a put or a put spread or a collar on a long equity position. These levered ETFs usually reset every day, so a lot of people don't even understand the mechanics of how they work. And also, a lot of people go to these products as some sort of way to stay away from options. They're terrified of options. They don't like options. They think they're risky. So they run towards these levered ETFs. And I always tell them, well, if you're doing that, how do you think they're generating these 1x2 or 1x3 type returns, these levered returns? They are using options. They're writing options on some ratio or buying options on some ratio or doing something in an attempt to generate those 3x or 2x returns. And those returns are usually approximate. They never really get that 2x or 3x that they promise you. And they use a lot of options and sometimes some, let's say, dubious constructions in order to do that. So my opinion on these things is always that it's preferable to go the options route. Clearly, I'm preaching from the choir. I'm an options guy. But if you've listened to this show and you've listened to the many different strategies we've outlined, you know that options, A, aren't risk additive. They're risk mitigating if they're used properly. B, they're not as complicated as you may think. They're very straightforward. What we outlined today was maybe one step beyond the basic stuff. It had a ratio involved, but it wasn't very complicated. And a lot of the other strategies we've outlined, the basic covered call, the basic protective put, these are very, very simple strategies. If you can buy a levered ETF, you can sure as heck buy a put. It's a pretty simple prospect. So these levered ETFs, I really counsel people to try to stay away from them. If you're doing them on behalf of your clients, trying to approximate some options functionality, I think you can do a lot better doing some of the strategies we've outlined on this show in the past. And of course, you can go back to all of our archived episodes as well to check out those, how we talked about constructing collars, about buying protective puts, about selling puts, and all these different things you can do in lieu of trading these levered ETFs that, in my opinion, just don't offer the bang for the buck that they promise and can actually add some risk to your portfolio. Randy, I'm sure you've encountered this as well, talking to different clients or maybe some gatekeepers who represent some of these other clients, and they say, oh, we like the levered ETFs. What's your take on these products as a tool for an advisor and their client?
Well, I think that you're not going to get the exact result that you want. I think it's very hard to quantify. I mean, I generally agree with what you said, and I would just throw out and say buying a put and kind of defining your risk over a certain period of time, whether that's 3 months, 6 months, a year, is much easier to do than to worry about how those ETFs are going to be reset every day and what kind of real protection they're going to provide over time. And I think that the results that at least I've seen have indicated that they are somewhat problematic in trying to reach those goals or objectives. So I would agree that using options is a lot more precise, using a surgeon's tool versus a saw to get the results that you want in terms of the two products.
And Mr. Kavanaugh, I'm sure a lot of your clients have approached you with this same question. What do you typically say to them when they bring up the levered ETF idea?
I tell them that they should read the prospectus of the levered ETF, and I tell them that there's a reason that the American Drug Association puts warning labels on cigarettes. It's the same as the warning labels they put in the prospectus for these levered ETFs. I mean, unless you're a professional and understand that these things are meant to track the daily changes in the index or sector or whatever they're meant to track. If you're holding them longer term, anybody that wants to go to Google and type out the word PATH, P-A-T-H, dependence, they'll learn that the long-term tracking of these ETFs basically have a route and direction towards zero. And they're just not long-term portfolio equivalents. If you're trading it day to day, if you're trading the options on the levered ETFs day to day, swim at your own risk. It is very ill-advised, and FINRA put warning labels on this thing, and anytime anybody puts warning labels that thick onto a new product, you really have to question, like, what are these for? Who are they helping?
Yeah, and then, of course, you get into the double danger zone. You start talking about options on levered ETFs. Then you have levered products on top of levered products, and you can go down a whole rabbit hole of danger and disaster using those as well. In short, we all agree here on the panel, these levered ETFs, they're usually not, you don't get what you've advertised. You usually don't get that 2x or 3x type return. They reset every day. That usually ends up, like Mike said, end up being a path to zero over the long run, particularly if you're looking at them as any sort of long-term investment. If you really want what's advertised and you want an approximate, and if you're doing it on behalf of your clients, you want to make it as exact as possible, then really options are the only way to go, and going out and constructing it yourself. If you know what your outlay is for a particular position and you know how it performs up, down, 5 or 10%, you know exactly what you're going to get in those different scenarios. And that's something you can rely upon, and you can give that to your clients as information saying, in these scenarios, here's what you're going to get. With these levered ETFs, you can't do that. So at the end of the day, I see the attraction, at least from a superficial perspective. They're simpler. They seem to be easier. They seem to offer a lot of the bang for your buck, but a lot of that is an illusion. You don't really get it, and they're not really easier at the end of the day if your clients aren't happy. And it might be a short-term, immediate solution. You buy one of these for a couple of ticks here if you want to hedge something, but anything beyond that, really, you should be looking into using options. And if you're listening to a show like this, Alex, hopefully you are interested in using options, and you've heard the different strategies and ideas we've outlined on this program, and you found at least one or two of them that you think would work well for you and your clients. Well, that's all the time we have for questions for this episode, and unfortunately, that's all the time we have for this episode of the advisor's option. But before we go, as always, I like to check in with my cohorts, my co-hosts, my partners in crime to see what they have cooking that may interest you. Before we do that, they couldn't make it on the show today, but let me, of course, remind you to visit optionseducation.org. That is the website for our friends over there at the Options Industry Council. And if you are an active financial advisor, click on the Resources for Advisors tab. They'll ask you to log in. You only have to do that once. And once you do that, you've created an account with them, and you can access a lot of their advisors' resources. And they have stuff like this survey I mentioned today and a lot of other great stuff, data on why collaring the Qs and the collar in general is a much more effective strategy than maybe you thought it was, and a lot of great stuff that you can take and arm yourself with when you're going out to meet with and talk with your clients about using options. So check it out, optionseducation.org. And once you're done with that, surf on over there to swanwealthadvisors.com and check out what they have cooking over there. Randy, what is coming up in the land of Swan Wealth Advisors?
Well, we obviously have several conferences that we're attending, but for the average investor that's interested or the advisor, I would just say to them, go to our website at swanwealthadvisors.com that has some of our more recent articles and shows and stuff like that on there. We just published The Good, Bad, and the Ugly, which is our second quarter analysis of what's going on in the world of options at Swan Wealth.
Yeah, and while you're there, of course, you can learn more about that mutual fund we discussed and how you could potentially add it to your employer's 401k plan, or at least suggest it to them when they're looking at setting up their asset allocation for that 401k plan. Because it would be nice if you have all these different funds that are just trading the underlying and different ways to trade the indices, whether it's a small cap and a large cap, maybe a fixed income type thing, and they consider that to be fully diversified and a good asset allocation for you. Maybe they rope in a fund that actually does some active option strategies, and that could really give you some interesting alternatives for that 401k account. And last but certainly not least, Mr. Kavanaugh, what is cooking over there in the land of RCM Asset Management?
Oh, we've got a lot cooking. So next Tuesday with the CBOE, our friend Marty Kearney, the legendary journeyman Marty Kearney of the Options Institute, and myself will be doing a 1-hour live webinar from the exchange floor on hedging concentrated stock positions. So that's next Tuesday from 3:30 to 4:30. I do believe it'll be recorded and archived as well. And advisors will get 1 CE credit for attending that webinar. And then we partnered with the Chicago Mercantile Exchange. We're hosting a 2.5-hour networking / cocktail / alternative investment education seminar for financial advisors that are using or are looking into use managed futures to incorporate into their portfolio as well. So that's October 2nd at the Merck's 20 South Wacker location. So those are the two important or more pressing events we have, and we're in the process of putting the event calendar up on our website as we have more and more speaking engagements and opportunities across the U.S.
And that's Tuesday the 24th, in case you're listening to this show after the fact. And I'm sure, like you said, you can find that webinar archived at the CBOE or perhaps at rcmassetmanagement.com. Just check it out over there. A lot of great stuff there, Mr. Kavanaugh. And, that's a good topic, the hedging of concentrated stock positions. We've had a lot of questions filter in about that sort of stuff here as well. That might be a good topic for an upcoming episode of the Advisor's Option. So maybe we'll leave that as a little bit of a tease for an upcoming episode of this program. And of course, like I said, if you'd like to join your fellow listeners and have your voice heard on this program, or if you'd like to just go and listen to some of the archived episodes of this program to see, maybe you want to go back and check out how we talked about constructing a collar or writing a put in lieu of working a long limit order on a stock. A lot of great things we've discussed on earlier episodes. You can find it all at theoptionsinsider.com. Just click on that radio tab on the top of the page, and you'll find all the archives of this show and every other program on our ever-expanding Options Insider Radio Network. And on behalf of myself and Alan and Eric, who couldn't be here, and good old Mr. Kavanaugh, and of course Randy over there from Swan Wealth Advisors, we want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program, and for sending in such great questions. Keep it up, and we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.